Hi, I'm Thomas. Welcome to the course Financial Management 2. We're going to begin with a lecture of Review Financial Management 1. An important component of financial management is knowing how to compile financial statements. The income statement includes revenues and expenses. The balance sheet includes assets, liabilities, and equity. Assets and liabilities are categorized as either current or long-term. The statement of cash flows reflects cash flows as operating, investing, or financing activities. And the statement of changes in shareholders' equity shows the change in equity over time, primarily reflecting equity issuance or repurchase, income, and dividend payments. Financial statement analysis is one of the key concepts of financial management. Horizontal analysis is looking at changes in an entity over time, usually a year-to-year comparison. Vertical analysis is doing a comparison of components of either the income statement as a percentage of sales or the balance sheet as a percentage of assets. Comparable companies analysis is comparing the analysis performed on a company to the same analysis performed on similar companies, companies which are in the same industry at the same stage of the life cycle as our target company. And financial ratios are analytical tools which fall into 5 categories. An example of a liquidity ratio is the current ratio. An example of a leverage ratio is debt to equity. An example of an efficiency ratio is asset turnover. An example of a profitability ratio is operating margin. And an example of a market ratio is the price-earnings ratio. The time value of money is another important concept relating to financial management, and you need to know how to take a dollar amount that is a future amount receivable or due and work backwards to the current day present value, either based on one payment or annual payments, which are referred to as annuity payments, as well as being able to take an amount today and forecast the future value of that amount in the future, either one payment or, again, annual payments, which are known as annuity payments. And present value and future value calculations are based on discount rates, or based on rates of return, which either result in a number growing into the future or a future number being reduced to a present number. The concept of working capital management is based on an understanding of the operating cycle and a business's seasonality. The operating cycle is driven by receivables activity, inventory activity, and accounts payable activity. And seasonality in working capital refers to the concept that a company's business activity isn't always stable over time, and in periods when there's more activity, there will be higher inventory levels, receivables will be greater, payables will be greater, and during times when the activity is slower, all of those amounts will be lesser amounts. When the company is at its lowest level, that level of working capital is considered permanent working capital, whereas when a company is in a peak seasonal period, the additional working capital amounts are referred to as temporary working capital. And how we finance permanent or temporary working capital will differ because of the nature of either being permanent or being temporary. Several examples of short-term financing for a company are bank overdraft. When a company's checking account goes to zero, there might be a feature in place which allows the company to continue to spend money, which is a type of short-term borrowing from the bank. A bank line of credit, which allows a company to use existing credit facilities on a short-term basis. Once those facilities are paid off, the company can redraw the same amount again. Accounts payable is a type of financing that is arranged through a company's vendors. Receivables factoring or assignment is a way to use receivables to be able to obtain short-term financing. And similarly, inventory financing is a way to obtain short-term financing. Both receivables and inventory are assets which can be used to obtain secured loans, short-term loans backed by a company's assets. That concludes our review of Financial Management 1. What we'll do during the first 2 weeks of our course is we're going to work through several examples of these concepts to be sure that you understand them and know how to apply them. I look forward to seeing you in class.